Welcome to the Sidebar with a CFP. Pierce the veil on BigLaw Life, career, and money. Hosted by Matt Smith, the tour manager for BigLaw attorneys. You bill in 6-minute increments. Let's get you some of that time back. In each episode, we will have candid conversations about life inside Big Law, the real stuff they don't teach in law schools or show in recruiter brochures. This show pulls back the curtain on what it actually feels like to climb the ranks, navigate transitions, and make big decisions in a high-stakes career. You'll hear from partners, associates, and experts across law and finance, each sharing stories, surprises, and strategies for building a life and career that works for you. This isn't a money podcast. It's a Life in Big Law podcast with a CFP in the host chair. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risks that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Now here's the host of Sidebar with a CFP, Pierce the Veil on Big Law Life, Career, and Money podcast, Matt Smith.
Hey everybody, welcome. Welcome to Sidebar with the CFP. Today's episode is a very special episode in which I'm going to speak to you directly from the perspective of a financial planner working with big law attorneys. A big part of the spirit of this podcast is to go behind the scenes to understand what it's like to be a big law attorney, not just from the financial perspective, but also from the career perspective and the life perspective. And at this time of year, January is when I'm recording this episode. I've been lucky enough to work with a number of attorneys who have been elevated from associate level to equity partnership at their firms. And one of the things that has become clear is that there are many, many shocks that come along with being elevated to partner status at your law firm. Typically, you don't really know what that entails, whether it's a financial burden or how the process works at your firm. And so what I want to do today is for any aspiring equity partners at a big law firm, I want to give you kind of a behind the scenes look on what you can expect. And I'm going to go through this sort of in a linear cadence across time about how things are presented to you, how choices are presented to you. And I've got a handy little guide here for those of you that are watching the podcast. If you want to email contact@concertplanning.com, I'm happy to send this to you, or you can just go to our website, concertplanning.com. There's this guide available that is the financial planning brief for big law partners. And there's also another one that is meant for associate level attorneys. But I want to focus on this one because it goes along with this time of year where people are being elevated and they are drinking through a fire hose once again as it relates to effectively starting almost a new career inside the law firm. So let's get started. So what I've done is I've put together a presentation that is 8 things to know about your finances. And what we're going to talk about is just the unique aspects of your financial situation. So if you have been an associate attorney for 6, 7, 8, 9, 10 years, and now you are being elevated to equity partnership, or maybe you were an income partner and now you're being elevated, um, your financial situation is going to change, not just your career situation. And there are a lot of things that you wouldn't know ahead of time unless somebody tells you. And it is unique to becoming an equity partner at a law firm. And so I'm just going to start at the beginning. Typically, what happens is you are elevated. You're notified that you've been elevated to an equity partner role at the firm, and you're invited to attend an initial partnership briefing. Basically, they will gather you either physically in a room together or on Zoom together. All the new equity partners in the firm, probably across the country, and you'll have this introduction to partnership presentation in which you're going to have the veil lifted and be told what the process is, what it means for you in terms of cash flows, how you're paid, taxation, lending, benefits, all sorts of stuff. So, one of the first things that you will hear about is an equity buy in. And this is a scenario in which you are going to be purchasing, buying into your initial share of equity in the law firm. And how that purchase is determined, what is the dollar value of what that's going to be? It can vary widely across firms. Every firm does it differently. But I think a fair representative example of what this looks like is something like 30% of your initial target compensation. For the purposes of easy math on a podcast, I'm going to say 1/3 of your initial target compensation as a partner attorney. You're going to owe that for your buy-in to the equity partnership. So let's say that your initial target income as an equity partner is $600,000. You have to come up with 1/3 of that amount to buy into the equity partnership just to get started. And so once again, I'm using easy numbers for easy math. That would be $200,000 that you have to come up with. Now, many associates or income partners don't have $200,000 sitting around available to be used to buy into the equity partnership unless they've been planning for this years in advance. Usually it's the case that the money's just not there. And so luckily, there are banks that will be integrated, partnered with your law firm, who are willing to lend you the equity buy-in money at very favorable rates. They can also make the process of actually obtaining the loan much more simple than it would be if you went to a non-affiliated bank. And that's because of things like they will have direct access to people in your HR department for income verification letters. They can spare you a lot of the paperwork when it comes to actually obtaining an equity purchase loan. So it's not the end of the world. You don't have to think to yourself, oh no, if I don't have $200,000 in cash or whatever the number is going to be, that you cannot become an equity partner. It's a very common situation. But from a planning perspective, what is ideal is if you have optionality. And so what that means is associates that I'm working with who are on a partnership track, who want to go that route with their career, we start talking about this years in advance. And we start talking about, hey, look, yes, you can borrow at relatively attractive rates, loan structures that are reasonable and manageable for you. But you could also save some cash. And even if the loan structures are fine and the interest rates are reasonable, it's still a 100,000, 150, 200,000, maybe more. It's still another, student loan size debt that you are putting back on your balance sheet. And so to the extent that you can prepare in advance and have liquidity and cash available to do this, it can really open up your options and let you be in control of how you want to go about doing this. There are all sorts of analyses that would go along with this. It's not as simple as, do I want to borrow money or do I not want to borrow money? If you're elevated to equity partner at a time where you're trying to buy a house or start a family, maybe you don't want to use all that liquidity on the equity buy-in. Maybe you want to do some sort of split where you'll pay some in cash up front and be able to borrow less along the way. But the most important part is you've been preparing for this years in advance, so that you have some optionality in how you'll handle this. So for those of you that are a third, fourth, fifth year associate and eyeing equity partnership in your firm, this is one of the first things that will be presented to you and one of the first things that you'll have to make a choice about when becoming a partner. Next is a change to the way in which you are paid. So if you have been an associate attorney or an income partner who's paid a traditional salary, and typically that comes with an annual bonus, sometimes a special bonus, that is completely turned on its head. You may not realize it, or you may not see it as a positive right now, but when you are paid a traditional salary and bonus, there are some logistical things that the firm is doing on your behalf that are helpful. They ease the logistical burden on you. One of those things is withholding taxes, which we'll get to at a later section, but they'll withhold taxes on your behalf. And another thing is a more steady, reliable, knowable stream of income. And when you move to equity partnership, you're an owner of the law firm. And so your income is going to depend entirely on the ability of the firm to pay its owners, to the profits of the firm, how the firm did relative to its budget. The net income of the firm goes straight to your pay. And so what that means is if you have a target income, once again, I'll just stick with $600,000. The firm is not going to pay you $600,000 in equal installments throughout the year, because what if there is not enough net income to the firm to support that? And so what happens, and again, these percentages can vary from firm to firm. You see this hypothetical example on the PDF. But generally speaking, what is going to happen is the firm is going to say your target income is $600,000. However, in order to ensure that we don't overpay you along the way and basically run out of money as a law firm, we're only going to pay you a portion of that along the way. And it's going to come in the form of a draw. And what that means is they may say, of the 600,000 that we are targeting for your compensation, we're going to pay you 250 of that periodically, monthly, usually once a month throughout the year. And so when you do the math on that, you'll have, X numbers of dollars coming into your bank account on a monthly basis. And often those draw amounts are lower than what your stable salary was as a senior associate. And so month to month, especially at the beginning of the year, when the firm is rebuilding profits, getting new revenue coming in, it can be pretty tight on your budget. And it can be a situation where you feel like, you're not making as much money as you were because so much of your annual income is going to be back end loaded towards the end of the year, depending on the profits of the firm. So you get these draws, they put the cash into your bank account. Some firms will withhold things from the draw on your behalf, like benefits and retirement savings. Some of them will do it periodically throughout the year. Some of them will do it once a year. Like maybe if you elect to make a 401k contribution, maybe they will take that out of one single draw at the end of the year, or even a distribution at the end of the year. So it varies from firm to firm. But the main point that I want to articulate to you here is that the reliable monthly income that you get is only a relatively small portion of what your target income is supposed to be over the course of the year. And that can really make your cash flows tight. And then what happens is they will periodically make distributions to you based on how the firm is doing, the profits of the firm, the budget of the firm, how much receivables are actually coming in, the billables that are actually coming in. And those distributions that are made to you out of the profits of the firm are typically timed to align with your quarterly tax payments that you have to make, that we'll talk about here in a few minutes. And so maybe you're receiving $20,000 a month in the form of a draw. And then suddenly you get a rather large distribution in April, let's say, to coincide with estimated taxes for the first quarter of the year. What you find is you get this large distribution. Let's say maybe it's a $75,000 distribution, and almost all of that has to be earmarked to pay taxes. And that is a function of estimated income throughout the year, what your estimated final income will be at the end of the year, and also what your taxable income was the prior year. Because what your tax advisor is likely going to say to you is, hey, we don't know exactly what your total income is going to be for this year, or really any year that you're a partner, because it can be so variable. However, we can pay at least enough in quarterly taxes to stay compliant and to prevent you from being subject to underpayment penalties. And so these quarterly payments can be rather hefty because they're based either on the prior year's overall tax burden and or on the current payouts you've been getting, and annualizing those. And so these distributions at first on paper feel like a lifeline in terms of new cash flow coming in and kind of catching you up when you feel like you're being paid less than you're used to via the draws. But a significant amount of these distributions will go to paying taxes. And you really only start to feel the relief as the distributions get larger towards the end of the year. The firm's profits are more concrete, more known, and they have a better ability to pay out more of your overall target compensation. So just to say, the way in which you are paid changes dramatically. It usually moves from twice a month to once a month. It moves from a somewhat reliable, equal installments of a salary to just a small portion of your actual total target compensation on a monthly basis, with periodic distributions that happen to line up with tax time and get eaten up by taxes in a lot of cases. So cash flow can feel very tight, particularly for the first 12 months or so. Another thing that can both reduce your draw amounts and make cash flows feel tight are mandatory retirement savings. So here on the slide, it says mandatory 401k savings. That's the most common thing, but there are other types of retirement accounts like cash balance pension plans and things like that, which you may be introduced to your ability and possibly your requirement to contribute to other such retirement plans as a partner. And these are retirement plans that you most likely had never heard of, and or features of existing retirement plans like the 401k that you most likely had not had experience with as a partner attorney. And so what's illustrated on the slide is the concept that most of us are familiar with our voluntary contributions to 401ks. So for 2026, you can voluntarily contribute up to $24,500 either on a pre-tax basis or a Roth basis to your 401k. Most of us are familiar with that optionality. And hopefully you as a big law attorney, depending on your situation, but most of my listeners and clients should be maxing out that 401k contribution every year. And most likely they should be doing it on a pre-tax basis. Not everybody, but in general. And that's all we know about the 401k. Maybe our firm gives us a match. Usually they don't. Law firms typically are paying high cash compensation, and the benefits are not quite as robust as they are in other industries. But you're most likely used to the optional deferral, let's say $24,500. You may be getting a match from your firm, and in rare circumstances, you may be getting what's called a profit share from the law firm, in which the firm can make an elective contribution to your 401k at the end of the year just based on excess profits to the firm. And what this means is, although in our heads we think of a 401k contribution limit being at, let's say, 24,500, because that's what our optional deferral is, and we don't have any control over the employer match or the employer profit share. 401ks actually have a much higher total contribution limit that can be met by those matching contributions and or profit sharing from the employer. And what happens is, when you become an equity partner and you are now both the employee and the owner of the firm, is you are very likely going to be responsible for making significant 401k contributions as an owner of the firm, separate from that employee deferral. So maybe your employee deferral of 24,500 remains optional to you. The firm will often say the match, if there is one, and or the profit share are now mandatory. And so what you find is that you may be on the hook for $40,000 to $50,000 in mandatory 401k contributions that are completely separate from your voluntary contributions. And this is cash that you had not previously been on the hook for as an associate, as a salaried employee. And once again, it's typically coming from a lower draw amount relative to what you were receiving as a senior associate in terms of your just traditional salaried income. And I've seen this in a lot of different forms. I would say that the generalization I would give is that you're probably going to be on the hook for the entire employer portion of what's available in a 401k, which again is $45,000 to $50,000. And then you will have the optionality to continue to make your $24,500 employee contribution. That will continue to be optional in many cases. And of course, the goal from a financial perspective is to be able to fill up the entire thing, because these are all tax deductible dollars. It is saving for your future that also reduces your current tax burden. But once again, it's really best if you've done some planning and have some idea of how this is going to impact your cash flows. In addition to the 401k part, often I will see pension plans in which, as a newly minted partner, you will make a one-time election that is effective forever, as long as the pension plan is in place, for how much you want to contribute to a pension. And once again, over the long term, contributing to and having a pension benefit is wonderful. It's really great. But usually you're faced with a choice of, do I want to contribute, let's say, $10,000 a year? Do I want to contribute $20,000 a year, 50, 75? What is it that I want to commit to contributing to this pension plan that will increase my savings, increase my retirement security, decrease my current tax burden, but it's also locked in for the duration of this plan's existence, which you ought to just assume is until you retire. And it can be a really tough nut to crack, because you know that right now your cash flows are tight because of many of the things that I've just spoken about. And maybe it doesn't feel like you're capable of contributing $50,000 to your pension plan. But you also know that in 5 years, all things going well, we can likely assume that that $50,000 pension contribution becomes much more affordable for you. And you know now that when you get there later, you will wish you had elected one of the highest, if not the highest, pension contribution amounts. And so again, you're faced with this near-term decision that's going to impact you for the rest of your time at the firm, or for the rest of the time that this pension plan is in place. And you may have to make sacrifices in terms of cash flows and accessing liquidity and things like that to be able to make what is going to be the best long-term decision for your wealth. So those are just a couple of things to know about retirement savings. Usually a significant 401k contribution becomes mandatory, more than you've ever been contributing on an elective basis as a salaried employee. And also there's likely going to be at least one other additional retirement plan for which you're going to either be required to participate at a certain level, or you'll have some optionality, and that optionality in real time can have a significant bearing on your future financial security. More fun stuff that makes you feel strapped for cash. As I've been saying, you're now an owner of your law firm. And so many of the benefits for which you used to share the cost with the law firm, you're no longer sharing those costs. You're going to bear the brunt of all of the costs of benefits because you're an owner of the firm. And so subsidizing yourself doesn't make any sense. The example I'll use are medical insurance benefits. If you go look at your salary pay stub, you'll probably see that you're contributing a certain dollar amount, let's say $400 a month for your health insurance. And then the law firm is contributing an equal or likely higher amount, maybe another $800 to your medical insurance. And so the total cost of your medical insurance benefit is largely subsidized by the law firm itself. Well, that all goes away now that you're an owner, and you're on the hook for the entire cost of the medical insurance. So your medical insurance premiums that are already high stand a chance of going up dramatically, tripling, let's say, by way of example. And so let's take a family of four that needs to be insured. If you want to be on a traditional PPO plan, which is probably what you've been electing along the way as a salaried associate, you may be looking at $25,000 a year in medical insurance premiums before you even spend a single dollar on medical services. That's just the premiums to have the insurance in the first place. And so the medical insurance is a striking example of this phenomenon, but it's going to apply to most, if not all, of your other subsidized benefits that you've enjoyed along the way, whether that be life insurance premiums, disability insurance premiums, any match that you may have been getting for a health savings account from the law firm, it's going to go away. You're the owner, so it doesn't even make sense to match. And typically these benefit costs are taken out of your draw on a monthly basis. Typically it is not a scenario in which they wait to take the cost of these benefits until the end of the year when you have a large distribution where you have more breathing room. Usually if you're starting with a $20,000 or $25,000 a month draw, you might be sending $2,000 or $3,000 out of that immediately just to cover the cost of your benefits because they're no longer subsidized. So once again, cash flow planning is really important in advance to deal with some of this stuff and not feel like you're strapped for cash all the time. Taxes. This is the fun part. Most people that come to me when they have found me specializing in working with big law attorneys, the primary concern, the primary pain point relates to taxation and how much money is going out the door via taxes and how can we mitigate that. Well, it feels somewhat more painful as a partner when you're paying your taxes because generally your federal income taxes are not withheld from a paycheck along the way. You get your draw minus the cost of benefits and potentially minus the cost of retirement savings deferrals. And it's up to you to go make estimated taxes directly with the IRS on a quarterly basis. And because you're having to pay the full cost of what your taxation is and see it come out of your bank account, it can feel worse than previously when it was coming out of your paycheck and you didn't even see the money in the first place. It was just a line item that reduced the amount of money that hit your bank account. It can feel like the taxation not only is getting more complex, but it's getting worse. And certainly as an equity partner, your taxes are likely to go up with your income, but it can be even more painful psychologically because you see every dollar going out the door along the way. Now, one of the things when they bring you into this new partnership meeting, sometimes they'll do it in that initial meeting, and sometimes they'll broach this in a special tax presentation or tax meeting. But as an owner of your big law firm that is doing business in numerous states across the country, you now need to be paying taxes in disparate states around the country. And so this could be costly from a perspective of, if you need to file taxes in 15 different states across the country, you're going to have to pay somebody to do that. You need a tax advisor no matter what. You needed a tax advisor even when you were an associate, but now as a partner, it's generally required. In fact, there are some law firms that require you to work with a tax professional, and in fact, tax professionals that have been vetted by the law firm itself. Because this stuff gets complex, you don't have the time, you probably don't have the interest, and this stuff needs to get handled, and it needs to be done correctly. And so you'll be presented with a series of options. Do you, like at the state tax level, do you want to file, let's say hypothetically, 15 individual state tax returns? And do you want to pay your tax preparer to do all that? It'll be expensive. Or for various states that allow for it, you may be able to opt in to like a group tax filing at the level of the firm, such that you're not necessarily having to file individual state tax returns. And or if you do, they're much more simple to file. And that sounds really great and nice because it eases the logistical burden and probably reduces the tax preparation cost. But there is another side to this, which is when you elect to opt in to these group filings, whether it's a composite filing or a PTE for some of the states that allow for that, often you are going to pay more in taxes along the way throughout the year as the law firm withholds on your behalf. You're going to pay more than you potentially owe. And when you go file your taxes the following year, you'll probably get a refund from some of these states, which always feels nice. But it's important to understand that you're giving away some money for an interest-free loan to the government along the way. And so it's a double-edged knife. Do you try to get it as precise as possible and add the extra complexity of filing in each individual state and of paying the extra cost to have a tax professional do that for you? Or do you opt into a logistically easier process that may take more out of your income along the way than is actually necessary? Really, I think what you'll find with the tax advisors is it depends on the state. It's a state by state choice to make. The choice has to do with how much revenue your firm is earning in a given state. What are the marginal state tax brackets in those states? There are a few different levers and knobs to turn to determine what is the best balance between opting in to some sort of group filing through the firm and or opting out and electing to file the taxes at the state level on your own. And I can tell you from what I've seen, usually it is a mix of the two. It's rare that I've seen anybody do all group filing elections in states where it is available. And in some states, it's not available at all. So not even a choice. Finally, lending. This is what I would say is, if it feels like I've been giving you warnings of terrible things along the way, I would say this is probably one of the more reassuring and better outcomes of becoming an equity partner. Typically, the world opens up to you in terms of lending from specific banks that will have relationships with your law firm, and or they have specialized lending groups within their bank that understand law. They understand the career. They understand the equity partnership nuances and the way you're paid and all that kind of stuff. And the reality is you can obtain lines of credit that maybe would not have been available to you earlier, which you can use to supplement an emergency fund. So let's say that if you've been working with me, you have $100,000 in cash, pseudo cash liquidity, like with a money market fund or something like that. But now you have a larger family, you have a bigger lifestyle, and maybe $100,000 worth of liquidity is a little less than what helps you sleep at night. And we would love to have more reassurance and more buffer there. Well, one of the things you can do is, instead of parking more cash in an account that is going to lose to inflation, most likely over time, you can open up a line of credit with a bank. That doesn't mean you're taking a loan. It doesn't mean that you're paying interest on this line of credit. What it means is, in the event that you need to access this line of credit because of some major emergency, you've gone through your true cash reserve, and now you're faced with potentially using credit cards to cover expenses for a period of time. Well, if you have this line of credit in place with a bank, those interest rates that you are charged are generally far lower than credit card interest rates, and they can serve as another line of defense in the resilience of your overall financial security. And ideally, you go through your entire life never having to tap the $100,000 emergency fund, never having to tap the line of credit. But the point is that these things are there and in place and making you more financially secure without you actually having to park more and more cash away along the way. And in other terms of lending, I referenced this earlier, the banks are going to stand ready to offer you attractive interest rates and loan terms for capital loans so that you can buy into your equity partnership. They are going to offer you attractive interest rates in terms of mortgage lending. Basically any kind, not any kind, I'm sure that there's some that are not applicable here, but many kinds of lending products, strategies, availability of credit are going to be opened up to you, such that if you are comfortable using debt in a wise way as a tool to improve your overall financial security and wealth, those opportunities are going to be there. And oftentimes it might feel like it's the deal that the bank is offering is too good to be true. And the reality is, I've seen that it's really not. What is happening is they are getting their foot in the door with you, because if they can help you on the lending side, if they can get you in on the lending side with attractive terms and rates, then they can try to expand the relationship with you. And that's not to say that you have to avoid that or be wary of that. It's just to say that they really are offering these wonderful terms and attractive deals, because it's just a way to stay in the good graces of your law firm and also develop a relationship with you. So that is the lending side. And so what are the planning opportunities for all this? Well, one of, I hope, the major takeaway is that your financial life, when you become an equity partner, will change dramatically from what you are used to. The way you are compensated is going to change dramatically. The way that you pay taxes is going to change dramatically, get much more complex. The way that you get benefits through work is going to change dramatically. The way you save for retirement is going to change dramatically. And so it's important to know these things ahead of time as best you can so that you can prepare. And I love to see my newly minted partners with significant liquidity available to them to help cover the first 12 to 18 months or so of equity partnership, where you're really not bringing in as much cash as you are used to. And a lot of the lump sum cash payments you're receiving as distributions are going to taxes. If a hypothetical example of one of my clients with $100,000 target liquidity fund is the generalization, well, someone who we know is on the path of partnership and wants to do it and is confident that they will get it, we're likely going to increase their liquidity going into that, so that they have that cushion there, that they don't feel cash strapped, they don't feel added anxiety about, just their bank account feeling empty when they should be feeling like they're on top of the world. So cash flow planning is extremely important. Coordinating with a spouse. If you have a spouse who has the opportunity to get benefits through their work, health insurance is the primary example. It's often wise to get on the spouse's health insurance plan as long as, your doctors and providers are available there. But yeah, that's that kind of planning opportunity that can come up. Developing relationships with the bankers as you become a partner, just so they know who you are. You don't really want to wait to develop a relationship with them until the point that you actually need their help. It's always nice to have just a basic introduction, let them explain to you some of the benefits they offer, some of the programs they offer, so that you know what's on the menu in the event that you want to take advantage of it. And in terms of taxes, if you don't already work with a tax advisor, first, shame on you. You should be working with a tax advisor. But secondly, if you don't, this is the time to find one. And you need a specialist. You need someone who understands the tax nuance of being an equity partner at a big law firm. This is not the time to try and penny pinch and try and get by either doing it by yourself in TurboTax or paying the guy down the street that doesn't charge much because it feels like all they're doing is filling out a form and documented data. That's not what they're doing. At this level of income and tax complexity, tax planning can make a huge difference in your financial life. Getting it right is critical. And frankly, offloading that burden to someone who has the expertise and specialty to do it, that's well worth every dollar it's going to cost you. I think that's basically the look behind the curtain that I wanted to give. And like I said earlier, if you'd like a copy of this PDF or presentation, email me at contact@concertplanning.com, or it's available on the homepage of my website, concertplanning.com. There's also a guide like this for associate level finances. And of course, there's a book that I've published that covers all these topics and more. And I think it could be really useful for you, give you a heads up on what you may be facing down the road. I don't want to dissuade you or scare you when it comes to becoming an equity partner. It can be an extremely rewarding, wonderful career path. But if you can do some advanced planning and know what you're getting yourself into, you can make it a lot easier on you, both psychologically and financially. And so that's what I want to leave you with. Thank you for being here today. I appreciate it. I hope it was a useful episode for you, and we will see you next time.
You've been tuning into Sidebar with a CFP. Pierce the veil on BigLaw Life, Career, and Money with Matt Smith. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risk that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients.